I may as well just kind of get the housekeeping items out of the way here. I'll do a brief intro, and again, I'll remind everyone here at the start and at the end to. I think I got the settings set that are a bit more idiot-proof, which I need help with some days with that to keep the audio and video at a minimum. But please just remember, we don't want to hear you flapping your gums, eating popcorn. Right, we're here to listen to Scott, and as much as we have to listen to me as well. Right, but yeah, I'll get us going here. As always, my name is Matt Mickelborough of Junior Resource Investing. I think this is our fifth. I'm not sure if Fireside Chat with Scott Macmillan here, Managing Director of Invictus Energy. I think he's qualifies as a friend of the show at this point. So whatever that's worth to you, Scott, I guess congratulations. But he's obviously, if you're following the story, you know that Invictus Energy, they've had their ongoing, years-long efforts now to commercialize their holdings in Zimbabwe's Cabora Bassa basin. Lots of kind of exciting and also frustrating news that has developed out of this. And I think that Scott, before we get going, I'm going to say this a couple of times. I'll thank him for his willingness to kind of sit here and listen to these questions and his good faith kind of approach to these things. But before I get kind of too deep into the weeds, though, as always, right, bog standard disclaimers. This is not financial advice. We're not financial advisors. There's going to be blue sky conversations. This is being recorded. It will be available on my YouTube. I'll have it out, and I'll have a companion article, Substack article as well to come out as well. If you have questions, please. I can see people already kind of throwing in well wishes into the chat. If you have questions, toss them in there. I'll do my level best. I make no promises, right? This is already investor based Q&A, so I'll see what I can do and see if I can fit them in organically, and if not, maybe at the end. But otherwise, it doesn't hurt to try, right? And I think this is I started here. I'll end here. Turn off your damn audio and video. I'm always tempted to make this kind of tech or view only, but I just think there's there's a certain degree of camaraderie with you gents in the chat like to get going a little bit. So Scott's asking me to unmute him already. So this is already my iron fist has already struck its first victim. There you go, Scott. I think I got you.
There you go.
Yeah, good. Welcome. Yeah. Anyway, so this is going to be all of the way here, right? This is going to be a bit of a different field than previous chats. Remember again that these are built off of investor feedback and questions. So if you have any questions around how that tone or emphasis comes to be, it's because of the collective effort from all of you. This one will have definitely a bit of a technical heavy, less of a technical kind of quantitative feel to it. And you'll notice that I'm riding solo today, and more of a sort of what you would call maybe a generalist or qualitative sort of update on the current state of affairs sort of approach. It's no secret that despite its discoveries and successes, of which there has been many, that the share price of Invictus has been floundering. And I mean, I'm a shareholder. It's one of my largest shareholdings. Never something you want to see happen, but here we are, right? And so I'm sure everyone is like me, where there's a degree of frustration involved in that, where you have what you thought was success, you made your speculative bet or your speculative investment, and it comes good. And so here we are, rather than the upside, we see downside. So with a huge and passionate shareholder base that Invictus no doubt has, Scott has agreed to once again to come on and kind of just address these concerns and speak to people and have people understand that, he's here, right? And so I want to, I guess, emphasize again my appreciation. I've said this at the start, his kind of good faith efforts to be here and communicate with us. He doesn't have to, and lots don't. I'm going to be asking some potentially kind of difficult and probing questions for Scott, and it's not my desire at all to bushwhack him for these. Or to make him feel like I'm trying to kind of catch him in an uncomfortable situation. But nevertheless, I want to make sure that I can still approach these conversations with concerns that investors have, right? So I just again want to preemptively kind of express my thanks to you, Scott, and on behalf of everyone here as well, for your willingness to actually sit down in the hot seat. And yeah, with all that said out of the way, yeah, Scott, welcome, and how are you?
Yeah, Matt. Thanks for having me once again, and to all the shareholders and those interested tuning in. Nice to be here. Wish it was under sort of better circumstances from a share price perspective, as you mentioned, Matt. But yeah, here to answer questions, concerns, provide a bit of context for everyone, because I think often what's difficult is to get across context, because we've only got a handful of mediums to communicate to our shareholders in, whether it's mainly through ASX platforms. So these sort of fireside chats provide that opportunity to dive a little bit deeper into what's going on around it. We can't, often divulge or can't ever divulge anything that's material that's not in the public domain. So, but I can give context around, particular things of whether it's results or decisions that were made or strategy and where everything is going. So
Yeah, absolutely.
I'll throw open to you.
Yeah, absolutely. I think that's an important point to emphasize here. I was just getting back into hot copper after a bit of a hiatus, and yeah, there can't be material information, right? This is not this is not the venue. This is not the conversation. And frankly, I hope it never comes to that, because that means that something's gone wrong, right? We can respond to information news releases, but it's not our job to break them here, such as it is. Anyway, with that out of the way, though, Scott, I've got a few different topics. I mean, share price valuations and current sentiment, I think, is, it's going to be sort of that umbrella topic that all the rest of the topics kind of nesting all into, right? But we'll cover financings, financials, future and non-dilutive funding, PPSA and sovereign risk flow test. You can kind of guess the greatest hits, right? And we'll go down and we'll kind of scroll through these as we go. I'm hoping maybe an hour and a half, but just generally speaking, right? If we can just start here, you personally, Scott, have a sense of what you believe the value, both kind of potential and present, of Invictus is, or what it should be, right? And investors, obviously, at least, if we're investors, we obviously share at least partly that vision with you, right? Obviously, this is not what's happening in the market with Invictus. And so, your shareholders, you, me, and everyone listening here, presumably, are all instead looking at 52-week lows on the heels of what we thought was a very kind of exciting and positive development with regards to M1 and M2, right? So before we get into the individual topics where we kind of try to suss out the hows and the whys and the whats of all that, right? Can maybe just, on a personal level, right? I mean, what's your internal dialogue? How do you, knowing what you've accomplished, as a company, and then you glance over at the share price, which I think is kind of floating, give or take a tenth. We're at 8 cents right now. How do you make sense of that? Where's that discrepancy coming from? Between what you believe it is and what the market is judging it to worth, and yeah, just maybe we'll start there.
Sure. Look, it's a real dichotomy for me, because if you look at the project, what we've achieved, making 2 discoveries, from Mukuyu 2 and now Mukuyu 1 as well, for a company that's gone into a frontier basin, never been done before. That's a phenomenal achievement that not many companies could claim, and it's a material discovery, and so that we've worked towards, and a lot of people have been part of that journey, and for me that's been 12 years now, maybe longer, and we thought we were kind of getting towards, if you take a kind of Mount Everest approach, we'd at least got to kind of base camp with getting a discovery, and that was going to be the kind of foundation that we were settling on, and we then have a clear runway ahead of us with a material gas field to go and appraise, a huge exploration portfolio as well that's going to unlock additional value, and we were going to be off to the races, and that's what we genuinely felt leading up to the discovery, that this was going to be it, and we were going to be set, because that has traditionally what's happened with every other company that's made discoveries. So really torn and feeling extremely proud, but also extremely disappointed because of the share price reaction, and I think that probably came across when we announced the second lot of discoveries on the 15th of December, when I had that shareholder briefing, and I was getting ready to come into the office to do that briefing, and I wasn't watching the screen or watching the market open, and someone sent me a message on my way in and told me what the share price was. I was just absolutely flabbergasted, and I couldn't comprehend it. So I think my frustration and terseness probably came across in that briefing, and it's continued since. So it's been very hard to reconcile what we know we have, what we've achieved, and how it's reflected in the share price. So that's probably what I'm most disappointed in. And as you said, people have believed in the vision of the company, what we're trying to achieve. They supported us, and we laid out what the criteria that we'd set ourselves, leading up to the drilling campaign. We were going to prove a discovery in the upper Angua, test the lower Angua, and we came up with a discovery there as well. And so that's what we laid out to achieve. And when we did and it wasn't rewarded, that was incredibly frustrating. And I think, and we can get into, perhaps what happened and the reason for the reaction, but it's just been really disappointing, the subsequent fall of the share price to where it is now, which is at a ridiculous level from a look-through valuation perspective. If you look at what we have in our hands from a resource perspective, from a running room perspective, it's it doesn't reflect the value of the company.
And so, if I can, just as a follow-up, right? I mean, I think that you're right? I mean, I think that we can discuss that there is a discrepancy, but I think that, for us, it's, I guess the why, right? I mean, is there something that you have circled? I mean, of course, it's a multivariate answer. There's going to be, X, Y, and Z that we can discuss. But I mean, is it sovereign risk? Is it that the PPSA continues to kind of hang over people's heads a little bit? Is it the funding risks, do you think? I mean, what do you circle when you're kind of approaching this, or if you're lying in bed thinking about a sort of thing, right? Where do you come from in terms of what you think the overlying or largest issue is?
Yeah, sure. And look, we've had, post the discovery and over the kind of Christmas and New Year period, we sought some feedback from some of our shareholders and everyone associated with it. I mean, the general viewers, and we were having, like a kind of spread in the office and amongst the insiders about where we were going to end up after the second discovery announcement, and the consensus was somewhere between 30 and 50 cents. And as I said, I wasn't watching the open on the day, but having spoke to some people who had, it was clear that that there was some dumping from one insto in particular who put their entire bid up on the screen, and I think scared a lot of people. It looked like, and I'm just retelling what people have told me because I wasn't watching it, that it looked like it was going to open at 25 cents and then build from there. And then all of a sudden the sentiment turned. We've got a lot of shareholders, and Invictus, I think, was a very well watched story at the end of last year in the market. Conditions were pretty tough, and I think Invictus was one of those potential shining lights that everyone was looking towards. And when that happened at the open, I think it spooked a lot of investors, some of who aren't experienced in oil and gas or don't understand it particularly well, and they think that someone knows something that they don't, and you have this sort of herd mentality. And when you've got the kind of volatility that Invictus has, it does accentuate those highs and lows, as you said earlier, and so that often, and we've seen it before in our stock, it triggers losses, and then it's just this kind of perpetual cycle. So I think there was that. I think the time of year was also not ideal from when those results landed right before Christmas. I know a lot of people who like to sell up their portfolio over that time of year. They don't want to think about it over Christmas and New Year and just depart. I think a lot of people were also looking at that when that result came out, whether it was a win, lose, or draw, that was a liquidity event and they were going to be out. I think probably the thing that exacerbated it the most was the fact that we'd had to sidetrack and we dipped into our contingency funding, and that meant that a lot of people kind of figured out that we were going to be coming back to the market fairly quickly. And so on the day that the results came in, there were no people stepping in to absorb stock that other people were going to trade on that liquidity event. And so it didn't result in that sort of normal kick that you usually have. And if we, I genuinely believe if we'd had executed on the main ball and we've got through that it would have been a different outcome. I think it was purely because we had absorbed that contingency funding with the sidetrack that people knew that we were going to be coming back to market. So that was unfortunate. And look, the reason that we had to sidetrack was because we encountered overpressured gas in Lower Angua, which was a good news story, but it does have ramifications and consequences that we had to then, undertake to meet our objectives for the well. We thought, though, that we'd still end up in a positive place. So I think everyone, not just internally with Invictus, but brokers, investor relations, advisors, that was the general consensus that we'd end up somewhere between 30 and 50 cents, because that's what, we thought was a reasonable valuation from a market cap perspective based on what we have so far. And that's so far. And so, yeah, it is disappointing where it's ended up. And then I think subsequently, what's happened is that we've had the rights issue, which took place, and that those are very difficult. They're cumbersome to put in place because it takes the prospectus, it takes a number of weeks to prepare all of that, and all the while you've had the sell-off post the discovery, which affects the sentiment, and it just drifted further. But we committed to doing it, and we committed to offering our other shareholders the same terms that we offered institutional investors. And so we went through that. We didn't think it was going to be that successful based on where the price was trading, but we went through with it because we're fulfilling our promise to our other shareholders. So it wasn't supported, and subsequently that's further affected sentiment because it hasn't been supported. So I think that's probably the summary of where we find ourselves today. I think also coupled with the fact there were some delays with some of the results coming out with the export clearances for the fluid samples and everything else, which has frustrated people. But we finished the well 90 days ago. It's still not that long ago. And I think everyone's impatient. They want instant gratification. They want to know the results now. These things do take time. So it has, it is very disappointing where we find ourselves, and it's our job now to articulate the value of what we have at Mukuyu, the additionality that we have with the exploration portfolio and how that's unfolding. And then also, I think, and what we have been working very hard on is where we're going to from here, from a trajectory of the company, what our plans are going forward now that we've made a discovery, how we're going to take the steps to commercialize this. So that's in progress, and there'll be a lot of developments on that fairly soon. I think also getting back to some of your previous questions on the financing and the PPSA side of things, I think that is definitely playing a part into it, where there's concerns now about how we were going to fund the forward work program, which is fair enough. I think and again, we had the belief that post-discovery we would re-rate and we'd be able to raise enough money to undertake our appraisal program of what we had for the next steps. So we've had to recalibrate that now, because it's clear that from a dilution and a further equity raising perspective, if you look at how much the market can digest, we're starting to get to that point now where we've been coming back to the market too often. And I think generally we had great support from our shareholders, and and that's been amazing. But we've got to that point now where it's becoming harder and harder to turn those shares over. So now we are going down from a financing path several routes. So some of these do take time to put in place, and that's there's basically four options available to us, which is the traditional JV route, and our initial plan was for us to carry on with the sole funding route past this discovery phase, do a bit of appraisal, increase the value of the company, and then we're in a really strong position to farm out and get great terms. But you can always execute a farm out ahead of those. So we're we're starting that process now to look at bringing in a partner. We have signed CAs with companies and beginning to to kick off that process. Now that we have a discovered resource base, that then opens us up to other forms of financing. A combination of debt financing from some of the development banks I've talked about in Southern Africa that we're in discussions with. Some of them are undertaking due diligence at the moment. You've got several of those that have provided funding to other companies. If you look at Renogen, if you look at Kinetico, some of those groups in our neighborhood are getting that type of financing in place fairly early on, because the thematic, and this is going back to the kind of long-term valuation and where we're trying to head. The thematic for energy and gas in particular is very, very strong, and that is not going to change where we are. So it doesn't matter how much gas we discover, all of it's going to get monetized. And so you have these banks in the region that understand that our energy shortfalls are really handicapping economies and industries there, and it's critical to have energy supply for just to maintain the status quo, never mind grow economies. So they're stepping in now and providing these typically much earlier than they would. We're also in discussion with service companies. They have some models which provide things like equity for services, or if they'll provide services in exchange for a portion of your future revenue or share of production. So that's another model that we're in discussions with some of the service companies. And then, of course, the final one, which we're also looking at and in discussions with at the moment, is through some of your midstream and downstream future partners, which need to secure feedstock for their processes or energy for their operations, and are prepared to provide you with prepayment or take an equity stake in the project or in the company. And you see this happening with a lot of the Japanese companies in Australia, where they take equity in the project or the company as a form of a hedge against the commodity price, even though they're off-takers from that project. So there's a number of those in Zimbabwe that we're also in discussions with. So those are the alternative financing routes that we're treading down at the moment, and we'll go down each one of those, and we'll find what we believe is the best route for us to go down.
No, lots and lots for me to respond to there. I think I might, and yeah, you've kind of dipped your toes into a couple different topics that I would like to discuss, but I think I might circle all the way back just as a follow-up. You did discuss, so just way back at the start, we discussed the kind of the day of Discovery Day, kind of D-Day there, that you had an insto dumping, and then that kind of forces us into this downward spiral. Then people realize there's a need for financing, and it becomes that sort of thing. So this is going to be, I'll transition from here to discuss financings for a second. And so is this? I might just ask you this to start the topic, and then move into the rest of my questions. But what are you doing if that is what occurred, right? And this is always what retail investors, when the boogeyman's real, we don't like that, right? Is this sort of stuff. But is there a way that you can mitigate that moving forward? What is there a lesson you can learn, or is this just a matter of you need money, and this is how the sausage gets made, and you have no choice but to be put over a barrel? But preferably, yeah. How do you mitigate or defend against predatory instos who don't don't care about your ticker? They just see you as a trading opportunity.
Yeah, look, sometimes that's quite hard because you don't know how they're going to behave until they actually do it. So we've seen that happen now, and that same insto bid in the raise that we did in late December, and we zeroed them out. We didn't allow them to participate. So we won't have dealings with them again because of the way they behave. We're not interested in having shareholders like that on the register, because they do more harm than good to the company. So it's it's very disappointing because that insto in particular has made a huge amount of money from Invictus in the past, and so you know you can't stop them from bidding in, because the brokers send them out to all of their clients, and often they're it's not just one stock that that these brokers and the instos are dealing with. The brokers will let them play because they want them to participate in all their other raises that they have for all the other companies. So, but as a company, we chose to zero them out.
Yeah, good. Well,
even though they did.
Yeah, fair. And so I mean,
so
fair? Go.
And yeah, so it's hard, and we do have new instos that have come onto the register since then, but I guess you don't have a you don't have a reference point for them if they've never been invested in the company before. We have had others that have been fantastic who, one of them put $5 million into the December raise and they're still holding. They're supportive of the company, and those are the type of instos that they see the long-term vision. They're prepared to hold and accumulate at these sort of levels because they recognize that it's undervalued. But it's a difficult road to tread on because these companies bid, you get names in a book. Some of them you've only had a 20-minute conversation with. Previously, you don't actually know them that well.
Yeah, fair. And I think that maybe is it a fair, not to belabor the point here, but I mean, I think that there's a sense among Invictus shareholders that that some of your value has kind of snuck out the back door due to these sort of predatory and bloodletting financings. The discounts and the options. Is that a fair assessment from your view?
Yeah, definitely, and I think part of that, and from a financing strategy point of view, it's difficult to manage because you've got to execute capital raisings at a point in time, and those are going to depend on a number of factors. One, how things are going company-wise and trajectory-wise, and two, what's going on in the rest of the market. So we're not immune to what's happening in the rest of the market and the general investor sentiment. So the structure of your raisings are going to be dependent on what's going on at the time and the risk profile of the company. And I think it's fair to say that wildcatting in Zimbabwe is about as risky as it gets from an investor point of view, because it's a jurisdiction that most people don't understand. Statistically, oil and gas wildcatting has a very low success rate, somewhere between 5 and 20%. And so you combine those two things, and it's you can't argue against some of the people that'll come back and say, well, to get us over the line, we need a little bit of a sweetener in this to make us bid. And it's a live process, and we did have the general support from our shareholder base, which allowed us to go on this sole funding route. And I think when we got to the points where we had to raise capital, you've got to fill it or kill it. And if you kill it, you then leave the company in a vulnerable position. So because then there's no money and you've got a big work plan and activity ahead of you. And so you do need to finance it. I think where we've got to now, although it'll probably be a little bit harder given what's happened share price wise, but look, it sort of reminds me of where we were in 2019 and 2020. Invictus as a company, and a lot of our shareholders probably haven't been invested that long. We've the register's grown quite substantially since then, particularly in the last few years. So late 2019, we we'd reprocessed the mobile seismic data. We were on the farm out trail, and the market was very tough. And then leading into 2020, obviously COVID happened. We nearly got a farm out deal over the line. I was over in Zimbabwe and elsewhere, basically negotiating the farm out deal, and then COVID swept in en masse, and then everything was, everything just stopped and fell apart. And I was on my way back. I remember that I was coming back from Zimbabwe. I've been trying to get the PEDPA over the line as well with government, and I'd spent quite a bit of time in Harare with doing that, and I was going to extend my trip because we were quite close. And then my wife said, "You better come home because they're closing the borders on Sunday." So I did, and I landed back in Perth 1:10 on the South African Airways flight, just as the market was closing. And then in the match, we closed at 0.8 of a cent. We had, I think, $2.5 million in the bank, and our market cap was 3. So basically, we were at shell value. No value attributed to the project. COVID had come in. There was, and we didn't know how long it was going to last. Oil and gas was, absolutely in the toilet. And oil and gas companies were being treated like lepers. So spent a long, in 2020 was really tough. And then I went over in November 2020 when the borders opened, when they started letting flights out of Perth, went over to Zimbabwe, spent some time with government to get the PEDPA over the line. We did the deal with Mangwana going back a little bit, in April 2020, where we'd been in this predatory cycle again with the Perth brokers, who can be pretty aggressive and push the stock around and bully you, try and force you into raises. But we broke away, and Mangwana came in as a strategic funder, and then that loosened us the shackles because the market knew that we weren't coming back. And so the only way then to buy stock, to get stock, was to buy it on market. So we need to I think, get away from this continual reliance on the market, because it doesn't provide the incentive for people to hold stock in the longer term. So that's where we're trying to position ourselves now. And as I said, we've got a huge support from Mangwana over there, and a lot of their investors and a lot of the pension funds. And off the back of that visit in 2020, we had a lot of heat on the PEDPA and why it hadn't been delivered. Government said it would be done before Christmas. It didn't happen. I was bitterly disappointed, because then over the holidays nothing happens. But we picked it up again, and by mid-March it was done, and it lifted the lid off the stock because we'd had the funding in place, we had the PEDPA in place, and that really lifted the sentiment because the sovereign risk element had disappeared, and the funding questions had disappeared as well. So we're going down a similar path now, where we need to get away from the reliance on continual equity raises through the market, and bring in some alternative funding routes. So I think, back to your questions on the PPSA, that's in progress. It's going well, and we should have a conclusion very shortly. I think some people might have picked up the interview that one of our non-exec directors, Robin Sutherland, did with Reuters, and mentioned that sort of timelines that government had indicated to us. So I think people should, have a little bit of faith. We've always delivered on what we've promised from a results perspective, from a risk perspective. When I'm talking about sovereign risk and having those agreements in place, and we've had continual questions over the years about the renewals of our permits, signing of agreements. None of that has ever come to pass. Everything's always been done. Sometimes it takes a little bit longer than we'd hope, but in the end, it's always been delivered. So Government's committed to putting the PPSA in place, and it will get done. It's a matter of time, and these things need to be done properly. I think the expectation from some quarters is that because it's an African nation and we're an Australian company, we can just barge in the door and demand that they sign an agreement. It's not how things work, and people wouldn't expect that of operating in Australia. You don't just go and kick in a minister's door's office and say, we need this to get our project done. You better sign here. So I think there needs to be a little bit more perspective on that, and that government has its process that it has to follow. And again, we're not just signing an agreement for an agreement's sake. This needs to ensure that the process is carried out properly and that it stands up, it's backed by legislation, and it's all done appropriately. Because if it's not, you're going to end up with a situation down the line where you have your agreements questioned, because sometimes governments do change, and your agreements need to stand that sort of change in dynamics, because you don't want to end up in a situation where someone points out some legal avenue that says, well, this process wasn't followed according to the legislation, and therefore your contract's invalid or your agreement's invalid, and then you start negotiating again, because that's a horrible situation to be in. So it is being done, it is in progress, and it will happen.
I think
so. I think those two things, I think, getting back to the kind of original point on the share price sentiment things, are also having an impact. It's mainly the financing aspect and the sovereign risk element. So, I've had some concerns from shareholders that have emailed me or messaged me saying, our license expires in June or August. I can't remember which month it is, but is it going to get renewed? Well, of course it's going to get renewed. We've fulfilled all of our work commitments. And by the way, this is the second time it would have been renewed. So we've been through this before when there was questions of, is it going to get renewed? And yes, it does. So people have been thinking we're going to lose the license and lose the asset and everything else. And it's just, that's not the case. So just want to make that clear and put that to bed.
No, I think that, there's a lot of things you say that I take heart in. Because it is one of my largest holdings, and it resonates with me what you say, right? I think that people, especially when you're in the red, I think it's easier to be impatient, right, or harder to be patient. But I think that people have the bad habit of judging a story before it's been told properly, right? That when we're still in middle innings right here, the game's not over, the story's not done, and so you can't assess, pass or fail, the success or failure based on on something that's only partly being told. At the same time, though, I can understand and appreciate. I do like that you reference that you've been through this sort of held hostage by the market, and you need to kind of break those shackles and move on. So I can appreciate that you've been there before with COVID, but that's still an uncomfortable position for shareholders, right? And so you're asking them to demonstrate that level of trust, and I guess you can harken back on previous efforts. But I guess, and again, maybe my transition here, I still want to talk about the current open financing, so I don't want to get too off topic. But when you talk about traditional JV or service companies or midstream, downstream, right? These non-dilutive financing options, as you say, to you can simultaneously tell the market to go stuff themselves, right? And then you can demonstrate that you don't need them anymore. But why don't I want to talk about that, so you'll excuse me, but let's take a half step back and just talk about the current open ongoing financing, right? Why? So I think you've already touched on this, right? That because of the sort of snowball effect of a variety of different issues. But why do you think that the SPP was so poorly received? Why do you think that it wasn't allotted properly?
So as I touched on earlier, I think it was really where the share price had drifted to by the time that we opened up. So SPP and a rights offer are different things. So in the past, we've done SPP, share purchase plans, which allows a shareholder, regardless of how many shares that they have, to purchase up to $30,000 worth of shares. Whereas a rights issue, you have a proportional entitlement. So this was a rights issue, And we had undertaken an SPP previously. This was last year in roughly April, which was really well received. And I think because of where it is a combination of two things. I think one, where the price ended up, where the offer was based on the same structure that institutional shareholders had in late December. So we provided to offer the rest of our shareholders the same terms. And by the time that the offer opened, the share price had drifted below that. And so for a lot of people, that wasn't a compelling offer. And I think secondly, because it was a rights issue and it was a 1-for-12 ratio, if you look at a lot of our shareholders who may have in the realm between $2,000 and $10,000, the effort to going out and subscribing for that, for a lot of them, the juice was not worth the squeeze, from a paperwork perspective and everything else. So I think that was really the crux of it. And, we took that advice from on the structure, and that was agreed with some of the cornerstones for that raise, that we would go out with this rights offer. And I think, in those kind of scenarios where your shareholders have that sort of level of investment, and it's a relatively small ratio, it's probably not something that most people will take up. So, but it's a tricky scenario because we went out for that amount of money, not necessarily the ratio. If we'd up the ratio, then a lot of the institutions then in the other raise, and a lot of them were unhappy that it was supposed to be 10 for the raise, for the raise in that December insta raise, and then 15 for the rights offer. And instead we did have quite a large bid for the offer, and so we ended up taking an additional 5 on the insta raise, but maintaining that 15, and a lot of the instos were unhappy with that. So it's very difficult to please everyone, because and probably the most difficult aspect of it is the time-based aspect, where rights issuances do take up a lot of time, and you're always going to have that lid on the price, because no one's going to step in to the market when you've got an open offer on. And so again, we undertook to do it to provide people with the same opportunities, but by the time we pulled the trigger, we sort of knew it wasn't going to work, but we went through with it because that's what we undertook to do.
So it's a question now around, maybe this evolving kind of theme of just demonstration of trust, right? That you're with us through this thick and thin, right? That we're all, rowing in the same direction. Do you, insiders that aren't fully allotted or not taking their full entitlement, do you want to discuss that for insiders or directors taking up the rights issue themselves? Do you place, it's sometimes it's largely symbolic, but there's still a functional importance to insiders aligning themselves and their cash with shareholders, right? Is this an opportunity that maybe that you could be displaying that sort of calm the waves sort of trust by participating, or why not?
Sure. It's a question that I think everyone gets asked, and all the directors have put their own money into this in the past. None of our directors has sold a single share. I don't think anyone, or vast majority of our shareholders, would be in that position where they bought stock and never sold a single share. So, my shareholding is still on SRN. I've never even bothered to transfer it over to an account. It's still sitting, because I've got no plans to dispose of any shares. I bought in my personal name in the past. I don't know how much more invested I could be in this company. Gabriel, one of our Neds, he's in the top 3 shareholders. Joe Matizwa, through his personal holding and through Mangwana, also top 3. So we've got three directors who are on the top 3 out of 5, top 5. The 3 of us are in the top 5 shareholders. John and Robin participated last year in their offer, and they put their money in. John bought more on market last year, so there has been that demonstration. So I think there's always that question when they come around, but we have put some into the company over the years, and we continue to hold them. So I think if you saw the opposite, if you saw directors trading it away, sure, you could ask those questions legitimately, but I think we've all proven our commitment to the company and our support in the company and our belief in the company.
Sure, and I guess it is sort of a shorthand for, our insiders invested metaphorically, analytically in the company, right? And so I mean, it's a fair point, but I don't think anybody here would ever doubt your commitment to what's going on there and your personal levels of commitment. But I think that just this is me editorializing a bit, and take that for what it's worth, but that there is a degree of symbolic importance, that especially just that pouring oil on troubled waters sort of approach, that maybe is something worthy of consideration, I suppose. I don't know.
Yeah, and there's still a shortfall, opportunity as well. So
yeah, it's just one of those things where buy signal, sell signal helps maybe reduce that volatility or fears of volatility, right? But why don't we? I mean, I'd rather talk about the non-dilutive financing opportunities that you kind of led us with. I think this is an exciting kind of topic of conversation for us, right? I mean, you mentioned JVs, debt financings. You mentioned, what else did you say? Service companies, midstreams. Can you maybe, I mean, not to belabor it too dramatically, but I mean, can you provide color on these? I mean, are you in advanced talks on all of them? Is this an either or is this all of the above? Is this something that we would see, in the next quarter or two? Is this something we'd see in the next year or two? Is there any sort of additional kind of content or color you can provide?
Sure. So obviously, for some of them, well, for all of them, they're confidential. But we are in talks for all of those avenues at the moment. So JV partners, we've got CA signed from a midstream and downstream perspective and some early monetization opportunities. That's also in progress, and we'll have something fairly concrete, very shortly. Service companies, we're out to tender with all of them at the moment, and part of that discussion again is the future program. Now that the service companies can see a long-term future in the basin, again, that then opens up different avenues in terms of services that we require for our exploration and appraisal program, and how that can be financed in a non-dilutive way. So that's either through future revenue or future shares of production are models that they typically take, and so that is that's another avenue that we're going down, and so that's a little bit of a combination with the midstream and downstream one, depending on which party we're talking about. From the development banks, as I said, once they see the kind of commercialization pathway, they can then start to put in place the kind of debt structuring that you need to finance to get to that first gas or first oil or first production. So again, in combination with some of the early monetization stuff that we're working on, and then the later full phase development, because they can kind of see, and for a lot of these banks, we've been in discussions with them a long time. They've been watching us from afar, and a lot of them from a little bit closer. Some of them are doing due diligence at the moment to prepare some of those scenarios for us with early monetization and then future phasing. And I think importantly, this early monetization pathway that we're pursuing will give people confidence that we can get all the approvals in place, we can produce gas, and get it to our customers and get paid for it. And that then allows us to show the pathway of how we're going to scale it up from there to get to the full field, because we've taken the sort of building blocks of what we need, and then that's just going to be scaled up on a very big scale, because we've got a huge opportunity from a market perspective with gas to power, fertilizer, industrial customers, mines, as well as feedstock for regional gas demand in South Africa in particular. And if you look at what's going on, and again, this is why the development banks are starting to get more active for earlier stage companies. I think the critical thing that's happening in South Africa at the moment is you've got Sasol, who have been providing all of the gas supply into South Africa from onshore Mozambique, from Pandentamane. Those fields are now pretty mature. They were brought online in 2002. Pandentamane is roughly 3 to 4 trillion cubic feet in terms of its ultimate recovery. That is now off plateau, and they've given notice to all of their industrial customers that from 2026 onwards, that they're going to be cut off from supply. So you've had consumers that have built in gas into their processes over the last 20 years that are now all of a sudden being shut off in 2 years' time. And so there's a scramble now for molecules and for resources. And so the development banks see a huge opportunity to provide that. That allows us to use ullage that's in existing infrastructure with the Romco pipeline. We're talking about in a later on down the line, exporting regionally to get it to a big market. I think that gas that Sasol sells, apart from what they consume for themselves, generates them 7 billion rand in revenue annually from those sales, even though they're transfer pricing. So that is, again, a huge market in addition to everything else. So the guys at the development banks we're talking to understand that story very well. And so what we're trying to do is leapfrog that process to get to proof of concept, provide that comfort around that pilot stage or early monetization scheme, which will demonstrate that we can get this to market, and then it's just a matter of scaling it up.
Yeah, okay. And so, and this is obviously, I think when we start, again, this maybe deep theme and developing just live as we go here is this sort of the continued need for the demonstration of trust, and then that sort of chicken or egg approach to, trust is earned, and it's this cyclical sort of thing. And so, I mean, yeah, this ability to disengage or divorce yourself from predatory instos who kind of bleed and no serious loyalty like you developed with your retail shareholders to your ticker, to your company, be able to get to non-dilutive funding, I think is a huge step. And I think that's something you've probably accurately described yourself, and something that, in conversations I have all the time, similar things. And so I guess maybe the question is, what do you need from where you stand right now as Invictus and in all of your totality? What do you need now that you don't have to achieve non-dilutive financing? Whether the data suite, I mean, is it a PPSA? Are there from your different, I mean, are there different barriers for different people? But is the PPSA not being signed, a barrier to entry for some of these people? Is waiting on the flow test and confirming it through their barrier of entry, right? I mean, do you need more wells? Do you need a confirmation of a certain size of field for these players? I mean, what's the threshold that you have to cross for these people to be willing to kind of come in?
Yeah. So it depends on which party we're talking about. If it's JV partners, if it's development banks, if it's everyone else. So everyone will have a different view and different requirements of where they go. I think certainly for everyone, having the fiscal terms settled with the PPSA will be a huge step for us, and will be a catalyst for a number of these. So that is what we're focused on in the short term, to provide people that comfort that the above ground side of things is all settled, and that it's going to be a stable and transparent framework that's going to govern this for the next few decades. So I think that's the sort of predication for a lot of people from an investment point of view. Less so some of the midstream and downstream guys from a local perspective, because they understand the jurisdiction well and they're not too concerned what our fiscal take is going to be. They just want supply. So that they've got different criteria. So they want to understand, when can they have it, how much can they have. So that is a resource size for JV companies. They want to get a feel for what they think they're going to go away and do their own work, what they think the ultimate potential is going to be, and then what's the running room that you have in the rest of the portfolio, because they want the upside as well. So that's why we fought so hard to get that additional exploration acreage, because we didn't want to do all of the hard work in making a discovery, proving a petroleum system, and having Mukuyu, and then you've got the rest of the basin open that allows other people to go in and tan in your sunshine, and just it's de-risked and that happens. So capturing that upside has been hugely important, and is a big, we've got other plays in there as well that are very enticing and are looking better now with these Mukuyu 2 results that we've had from some of the fluid analysis as well. From the development bank side of things, you've got a combination of a minimum resource size, because they want to know that they're going to get paid back, and then also the above ground and contract stability side of things. So we're taking this phased approach so that we don't have to drill out the field to get an appreciation or an understanding of the full resource size. What we're trying to do is concentrate on a minimum size development that will get us to that first hurdle, and then build it from there, so that we can start to self-fund some of the future development. Because you can take a very kind of big company gold-plated approach where you want to understand as much as you can, and there's always more comfort in getting more data, but at some point you're going to have to step out and put your balls on the line and go and drill it. And that's what we did with Mukuyu. A lot of people said, why are you drilling without 3D? It's because we don't need to drill with 3D. We're chasing something big, and it's either going to be big and it works, or it's not going to be worth bothering with if we can't find something on 2D. So that's, we could have shot 3D. Would we have had a different result? Maybe we would have had drilled somewhere else, but we would have still made a discovery. So you can waste a huge amount of time in trying to get comfortable with what the subsurface is like, and the fact is, you're never going to have perfect information. You're always going to have surprises that are going to be thrown up at you. It's trying to capture the range and uncertainty, and making sure that you've got everything covered in that, so that if you do have an adverse scenario, whether it's upside or downside, you can kind of fit it into what you've already thought. So that's that means we're going to try and get this done with as few wells as possible. So that's the aim. And we need to drill. We're going to have to drill some more, obviously, to get to a kind of production threshold. But I think what we can demonstrate is that with some of these early monetization schemes, the kind of rates that we're going to need to get to that minimum threshold, and whether that's 1 or 2 wells, we'll see how many of these early pilot developments we can get up and running, because we're taking an approach where it's not gold-plated full field development as the first cab off the rank. It's going to be a stage and a ramp up approach to try and be a little bit more manageable.
Sure. At the risk of being repetitive, though, just for sake of clarity here, so let's assume, next 3 to 6 months, PPSA occurs and the flow test occurs, and both are successful and confirmatory, to the upside for Invictus. Is that enough for kind of the nascent beginnings of non-dilutive financing, or is that enough for some potential partners, or is there more to be had?
Yeah, I think certainly the PPSA, I think for a lot will catalyze a number of those. Some additional data from post-well studies as well will just provide some more confirmation, and that that will crystallize a lot of these plans that are going on in the background, and some of them will come ahead of that, as I said, with some of the local midstream and downstream early pilot stuff that we're pursuing at the moment.
Sure. And so why don't we discuss, I have a couple of other topics too, but let's just switch to PPSA. I think that's a decent opportunity for a transition here. And again, I always, it's one of those things where I said this and I'll emphasize again that I recognize this material, that I'm not going to ask you or insult you to make you assume that you would be able to suss out material information from even a public forum, right? So let's just play fair game there. But I mean, I'm still going to try to pick around at the edges a bit, because I've left it off the last couple of conversations, because no news means there's no update, means you can't tell us anything. But let's if you don't mind, I'm going to pick away at this a little bit here. I mean, again, can't tell specifics, but I mean, just internal metrics. Have you satisfied all exploratory and discovery work in terms of data and all that, and kind of internally, or are things still progressing in some way? I mean, are there sort of internal triggers or checkpoints you have to hit to for this to come good, or have you already hit those already? Hold on, I think I see you muted. I'll get you unmuted here, Scott. There.
Thanks, Matt. So this is in relation to the PPSA you're talking about.
Yeah.
So look, we've I think I'm not divulging anything that we haven't had before, so or discussed before. So the PPSA really is based on the previous Mobil agreement, that when they were exploring the country. Now, what's happened since Mobil were exploring is that we've had a split in the ministries, where energy and mines used to be one single portfolio, and now there's two portfolios. So the PEDPA is governed by mines, which is already signed, which we did in 2021, and that provides us with the production pathway to get all the way through to production, and provide us with a 25-year production license, which is renewable for another 25. That's already taken place for a number of coal bed methane developments there. We don't need anything else to go into production. The PPSA, though, is a fiscal framework that's being placed on top, which allows a fairer share of the resources to be distributed to the country. At the moment, the only fiscal terms that are in place for oil and gas in Zimbabwe is a 2% royalty on gas, no royalty on oil, and corporate tax. So it is the best fiscal regime on the planet for oil and gas. But that is not going to stay in place, because it's not a fair share, and that's because Mobil previously had the production sharing agreement, which had that fiscal arrangement on top, which interacted with the mines legislation, which governs royalties and everything else. So with the PPSA, that now sits in the purview of the Ministry of Energy, and they are responsible, and it has some interaction as well with the Ministry of Finance. So that agreement has been put in. So we split up the two agreements. PEDPA signed, PPSA has been in progress. It's been independently reviewed twice by two different legal firms out of Europe. One of them was sponsored by the Africa Legal Service, because there's no capability from government's point of view that would allow them to negotiate with us, and that not be perceived to be an unfair playing field in terms of the experience and know-how of how these agreements work. So the government sought to have it independently reviewed or reviewed so that they at least have an independent view that the terms were fair and reasonable, and that what we're proposing to put in place is not, we're not trying to prejudice the country of anything, or trying to get in something that that is untoward. So those comments have been, we've had a review of them. There's nothing there in terms of the fiscal provisions or the comments that we're unhappy with, that aren't reasonable from the independent review perspective. And now it's a matter of finalizing it and tidying it up to put it in place. So that's all been done, and it's really just now the principals in the senior ranks of government getting comfortable with the structure of it, what it means, how it works, so that when they stand up in Parliament in the future and they get questioned by other MPs, where they can stand behind and say, this is a fair agreement, it's been independently reviewed, these terms are commensurate with our regional neighbors in Namibia or South Africa or elsewhere, and we've got a good deal for the country, it's fair, it's a good deal for the investors, and this provides a framework where this development is going to be shared, and ensures that that everyone over a long period of time, these developments often run for decades, is happy and it's stable, and there's going to be no changes. Because I think the worst thing that happens is when you have an unfair agreement and then one side goes in feeling that they have been prejudiced, and then it does tend to get very ugly. So in taking those steps and putting it in place, it needs to be done according to the legislative requirements, so that in future it does stand up to scrutiny. So part of also what's happened now is with the constitution of the Sovereign Wealth Fund of Zimbabwe, or as it's now known, the Mutapa Investment Fund, is that they are going to be allocated the equity share for government, and then also the split of the product or profit that will come in, so that that's preserved for future generations. So they've now had to become involved because they're going to be acting on government's behalf. So that's taken a little bit more time, because that board was only constituted post the election, and the CEO appointed only very recently. So we're getting them up to speed, but they've now got the authority to conclude the agreement. So that's being worked on, it's in progress, and it's going to be done, in the very near term.
So is it fair to say, just a couple of brief follow-ups, that the guts of the minutiae of the actual terms of the agreement have been largely been agreed upon for some time? It's mostly just about...
It's based on a model contract, that the industry uses, and adapts according to, some very specific local variations, but the materiality of the terms that's been in agreement for a long time.
And so then is this a matter of internally they're waiting for kind of checkpoints just like we are, whether it be a flow test or something to that effect? Is that something that they're waiting on?
No, that's got nothing. It's got nothing to do with it from a flow test perspective or any other data. It's and I think you've seen all the positive noises coming out of government on how excited they are and what it means for the country, and I think that's also reflected in the local investor sentiment as well. So
sure, yeah, fair enough. And so we'll transition to talking about the flow test here and M1 and M2 data in general as well after that. But maybe just as kind of a bridge between these two topics, is there and this is a question I'll return to in a second in terms of a more generalist sort of approach, but just in terms of your holding your cards close to your vest, I mean, is the PPSA something that maybe after you, and this is just me speculation and surmising, so tell me if I'm off base here, but is there a moment in time where you will have enough confidence in what you own and your hold on it that you will be releasing more data to the market, or is there stuff that will always kind of remain proprietary in nature and you'll hold under the covers?
Look, some of it is proprietary, but it also depends on the materiality threshold. So, that's what the real sort of test is, when it comes to disclosure, and all of that. And I think I know where your question's going in terms of log data, core data, and anything else, which is all calculated and fed into your net pay. So when we do get new data, we're going to evaluate that and see what we've put out to the market before, and if there's a material change, then we provide an update. But releasing every single piece of data under the sun is not it's not practical. And also, I think people need to understand the type of data that we have and how that fits in with the reporting. So we don't have whole core. We've only got core plugs, which is a very minuscule representation of what your reservoir interval is. So, and some of them get damaged when you acquire, particularly the better ones, because they tend to be friable and they crack, and sometimes you can't get data and measurements on them. So when we provided a range of what the results are, provided we're still within that range that we've reported, then there's no materiality change in that. So that's the sort of view that we take. I think from a fluid composition perspective, that's important, because it's material to understand whether you've got gas condensate, oil, and whatever else. So that is material, and that's why we release that. We put ranges of our porosity and saturations and net pays in our discovery announcements. And again, if that changes, then we'll feed it into the market when we've got the data to back it up, and we've done the work as well. So.
Well, good. No, and so I've got a couple that I think might be a little bit shorter in terms of just the answers and questions involved. But flow test timeline for flow test and 6-inch drill, is this still something that we anticipate Q2? And in terms of financing, where is it for being funded?
Sure. So had a lot of questions on the flow test, obviously, and that's been probably at the forefront of everyone's minds. So it's at the moment, as we put out in an announcement a couple of weeks ago, the well test design work is ongoing at the moment. We've got some independent parties doing that. The reason being is that one, well testing is a very, very specialist kind of boutique skill set. I don't have the time to do it, and I've had to put down the tools, mostly, as much as I do enjoy it, and kind of hand it over so someone can focus on it without all the other distractions that I have. And we've got, two major reservoirs in the upper Angua and the lower Angua. We've suspended it down to run the liner down to 3,000 meters. And so to test the lower Angua, we'll have to drill out 6-inch hole. So the testing is a combination of a few things. We've got about 8 or 9 different permutations of how we can conduct this well test. So we want to go through all of them and evaluate it. I think particularly from a funding point of view, we want to make sure that we get the maximum impact for when we're going to undertake a test. We make sure that we're getting the biggest bang for our buck. So that requires not only the surface equipment, but also drilling, because we're going to go for the 6-inch hole option so that we can test the lower Angua and evaluate that deeper overpressured gas that we haven't accounted for as of yet. So we demobilized all of the well services equipment at the end of the Mukuyu 2 campaign so that we can reset our service contracts, because for Mukuyu 1 and Mukuyu 2, we were not in a great position to demand any kind of reasonable terms from service companies, because again, it's this risk profile where wildcatting in Zimbabwe, you know, what crazy people go and do that in somewhere it's never been done before. The service companies have never been there. Wildcatting, low success rates. So odds are these guys are going to have 1 or 2 wells and then that's going to be it. And it's hard to get services. So, you know, we can be aggressive on our T's and C's, which is what happened. So now that there is long-term work in the basin, we're in a much better negotiating position. And so we demobbed everyone, apart from the mud logging, because those guys are fabulous and they've been good. And we've got a reasonable retention rate with them, so that we can go out to tender again with all these service companies, so that we can sharpen up the terms and get a much better deal. So the wells in the future will be a lot cheaper and a lot more efficient. So, you know, the big challenge we have is not actually when we are drilling, it's the mobilization charges and lead times. And, you know, a lot of the difficulty that we have is sourcing equipment from all over the continent and sometimes beyond. And when you're trying to coordinate all of that equipment to arrive in one place at one time, and you've got tens of thousands of pieces of kit that have to arrive, clear customs, the paperwork involved to export it out of other jurisdictions is cumbersome. And now what we're doing is getting them to consolidate it in one place. We go pick it up at once, bring it in. And now we've got, you know, particularly in Namibia, which is obviously very active, the service companies are moving their bases down to there, which means we're going to have much more ready access to services gear. So that means we can mobilize quicker and reduce that time frame from when we mobilize equipment, drill, and demob if we're going to demob. So, and there's obviously the well test package. So there's from a timeline perspective, we're looking at as early as June, and then into later in the year, depending on which service company we're talking about, and also what equipment availability, depending on the operator, depending on the service company that we're talking about. So once we finish the well test design, which will be in the next few weeks, that will kind of dictate then when the timing of the test is going to be in concurrence with who we're going to pick, because we're evaluating all the tenders at the moment and going through the commercial proposals from the service companies. So that'll provide us with a better time frame for when the test is going to be.
So yeah, June, and then in terms of funding.
Yeah, so that gives us that time to sort that out as well in the lead up to that. So we're obviously continuing with some of the procurement for long leads and everything else that we need in the interim, because that's common no matter who we choose. It's really then just the services for drilling and deepening and the well testing, and that will be done. So we will we'll have to drill and deepen first, and then we'll conduct the test.
And so again, on the notion of there's a question of, and this is kind of going back to the same sort of doubts that arise in the absence of data, people will make up their own stories, right? And you know, fair or foul, good or bad, that's just what human nature is, right? And will it flow? I mean, there's people that are expressing doubt it will flow. I mean, you've stated pretty unequivocally in previous conversations we've had, but people are, you know, these message boards, which we've talked about. I mean, poor perm, you know, the need for hydraulic stimulation. Is there something you can provide clarity on this, or is this something that really just can only be solved by flow testing it and demonstrating it to the market?
Will it flow? Well, yes, we had gas influx into the wellbore. We had tripic acid built up, and that's with mud in the hole. And after we weighted up, so you take the mud out of the hole, you perforate it, get past, and you've got no medium trapping it. Then yes, so that's the simple answer. The rates and everything else again depends on how we test it. And going back to going back to the well test, we've got a number of permutations of how we do it, and whether it's commingled and the different pressure regimes and the different zones. So that's again something that we've got to figure out. So
Sure, but yeah, short answer, yes. Now, is that upper Angua and lower Angua? Are you both confident in both of those, or is there a potential for that hydraulic stimulation at all? Or
look, on the hydraulic stimulation question, I think one of the you can stimulate anything. It's a question, and I think people get hung up on this where it's really a matter of economics rather than anything else. So we've got, and clearly in our reservoirs, we've got some variability, which is what we've stated in our results. So we've got some stuff that's good and on the conventional classification, and then, as we said, we've got a lot of that we've currently classified sitting below the net threshold from a conventional perspective, which is still going to contribute over a longer period. But currently, we've applied that conventional net cutoff and is not there. So you can accelerate that through things like stimulation, or if you wait long enough in your drawdown in your better reservoirs, and your pressure depletion gets to a point where it allows that to flow, then you're gonna get that at the back end and have that as a kind of cushion from a pressure perspective and a volume perspective that will start to contribute. So I think, at the moment, we're going to focus on where we think from a resource and a maximization of that, and from I think people look at resources and they look at a number overall as to what it means from a value perspective. So we've got to take that into account, and if there's a way to, I guess, capture some of that from some of that current non-net, if we need to go down that route, that's something that we should look at. So I wouldn't rule it in or out at this stage. It's an engineering technique to recover other resources. So
yeah, nothing
doesn't mean there's no gas there.
Sure, yeah, fair enough. Yeah, fair enough.
And if you look at,
no, you go, Scott.
yeah, and if you look at even the Perth Basin, that's been the case, where even at Waitsia, which has got Waitsia 4, we flowed at 90 million cubic feet a day, but we still had plans to hydraulically stimulate the Highcliffe reservoirs below that, because there's a substantial resource there that's going to contribute, and any molecules you can sell, provided that your cost of extracting them is lower than what you can sell them for, makes economic sense. So it's I don't think people should get twisted off if we've got some tighter reservoirs in amongst it. It's understanding what the overall resource is and what the commercial equation is to extract it and process it and sell it. So
fair enough. Yeah, and then that conventional versus tight. Yeah, no, good. So
yeah, and you're going to have a mix. You're going to have a mix of it in every single field that you encounter. Not all of it is going to be the same. You're going to have some good quality stuff, some some average stuff, and some poor stuff. And it's about what are you, how can you do it effectively? And clearly, in an offshore environment, that is more challenging because of your ability to deploy things like stimulation techniques. Onshore, much easier because you've got that footprint. You can bring stuff in and out much cheaper than trying to do it off a platform or a drill ship or anything else. So it's it does open up more avenues, and that's why we've seen. You look at the US where they are stimulating and selling gas at a $1 handle in the US. It's ridiculous. How far that our engineering has brought the cost of stimulating rocks and getting it out of the ground and selling it. Look at the Beetaloo in Australia. So same thing. You've got now companies targeting exclusively shale not even, no conventional in it. It's shale, not even tight. So it's a question of economics. So it shouldn't be thrown away. It's a part of the resource mix that you're going to have. It's whether you can get it out at an economical rate. Obviously, conventional stuff is more economic because your well count's lower, your spacing's lower, and your cost of drilling them are lower. So that's what it comes down to.
Well, let's discuss other lab results then too, right? Moving on in this area of subsurface data. I mean, what's left in the lab right now?
So we've got some additional PVT stuff to do from a fluids perspective. So this is the more kind of detailed phase behavior stuff that reservoir engineers love to look at. That helps set up your your understanding of the subsurface and your saturation pressures and how your gas and condensate and oil is going to behave at different pressures and temperatures through the wellbore, and how you initialize your models. The core data that's got to the labs now and is being processed, it's being photographed. The cores have got to be cleaned, and they've got to go through their routines. So you've got routine core analysis, and then you've got special core analysis. So there'll be a series of screenings for those core plugs to see whether they're suitable. Some of them are going to have fractures in them, which means you can't use them for analysis. And we've got a mixture of stuff that we can use and stuff that we can't, because although we got a lot more sidewall cores, the XL rock, which is the big boys, the big boy cores, that only worked on the motherboard, and the tool failed right at the tail end of that run, and so we've only got the conventional size in the sidetrack. So we've got a mix of stuff. Some you can look at kind of anecdotally, and some you can do actual measurements on. What else is in the labs? You've got obviously all the log data, and in this well we had FMI, which is a formation microimage log. So it takes a kind of image of the wellbore, which is very, very useful. It gives you a lot of information from a depositional setting point of view, from a paleo dip current point of view, and a lot of other stuff that the geos like to look at. That takes a while to process and interpret and unpick. So you've got it's like a 10,000 piece jigsaw puzzle that you've got to put together. And again, it's still very, very early on. And I think, we go back to the Perth Basin, which I like to refer to all the time. If we look at Seismic 3 and Waitsia 1, so Seismic 3 was obviously the discovery well, and Waitsia 1, that, were the first two wells of what we proved up. I think the first reserves booking or contingent resources booking was around 150 or 200 BCF. What we've done with this, and these are independent kind of numbers, we haven't put out our internal numbers, and we've got to do a little bit more work before we're comfortable in putting it out, because once a company puts it out, it becomes, people anchor on it and it becomes gospel, and any changes to that people tend to view very dimly, particularly if it goes backwards, which is 1.2 TCF. So that took like 10 wells in the King Ear Play in the Perth Basin to get to that sort of number. So I think people need to be a little bit understanding that it's still early on in the journey. And getting back to the valuation point as well, when we were working in Waitsia and we were looking at the data and about how I feel about where we are versus value, we had a really similar kind of scenario at AW when I was working there, looking at the data, seeing the results. We put out these great results from the wells, from flow tests, and the value of the company did nothing. Share price didn't move, and it took until there was some external validation from third parties to really move the story. And if you look back now, early last year, same thing with Warrego and Strike. It took some M&A moves from Strike making a bid for Warrego, where they understood the internal dynamics of and the subsurface and the value proposition of what Warrego, their JV partner, was sitting on, and they made a bid for them, and then it sparked a rush with other players. Some of them, Beach, who were also in the basin, who also had an internal view, and And then Minres, again, who also had a position in the basin and had an internal view, that, you know, they knew what the ultimate value was. And you saw, you know, Origo acquired for like 2.5 times of what they'd been trading at pre the first bid from Strike in that round. So yeah, I think sometimes it takes that sort of external validation to kick off for someone else to put a marker down for evaluation perspective. So that's a little bit trickier for us because we're the only player in there. So I think any form of external validation coming in for us, whether it's through service company, JV partner, downstream, midstream partners, development banks, that provides that for people to say, you know, we've had a look and we know that we're off to the races here from a monetization point of view and a development point of view.
No, excellent, and it does all tie back together, right? Well, will we see a resource estimate increase potentially from this round of lab data? Is that in the works or no?
We haven't put out any reserves yet, so I think people are referring to the net pay criteria. So that will be used to calibrate our log data. So as I said, we've got some that falls under the current threshold of what we define as net. And I think if you look, when we were doing the fluid sampling, we went and tested just to get a fluid type and a fluid ID, and those with a technical background who've been involved in these sort of operations will understand it. Where we started drawing down, we started sampling from the side of the borehole and pulling fluid out of the reservoir. We did that in some rock that was below what we put as the net cutoff and successfully flowed gas through there. So we weren't taking samples, we were just going down to get a feel for dynamically what kind of cutoff we could use. So we've got quite a lot of that sits below that net cutoff, and some of that will come through confirming it in the lab, because with net pay numbers you're using at the moment kind of arbitrary static cutoffs where you've got a net to gross number, you've got a saturation number, you've got a porosity number. The rocks in the subsurface, they don't know what those are, so they're just rocks, and it's either going to flow out of it or it's not. And having something that falls either side of an arbitrary line, it doesn't suddenly say, oh well, I'm, you know, let's use a random figure, I'm a 49% net to gross or V shale, and therefore because I'm not 50, I'm on strike. So you refine this over time, and what really helps is that well test, and if you can put spinners in the wells that'll show you what's kind of contributing, or run a temperature gauge to show you what fluids are coming in. So that then helps you get a feel for where your cutoff should be. So we've come out with the preliminary net numbers, and those will change. But again, we need the data to give us that comfort and ability to go out and change it, because we don't want to suddenly have a reevaluation where your net number goes backwards, because that doesn't help anyone, and it damages your credibility. So we've seen that with other companies, and so we don't want to fall into that trap of getting, you know, throwing the anchor out so far, and then you've got to pull it back, because, you know, that's not a great look in my opinion. So yes, once we've got the info that we can back up, and some of it is feel, some of it is you know, educated guess, but we want to be able to back it up with data that we're comfortable with.
Is the gas pressure the same M1, M2, upper and lower Anglo, or is it the same gas pressure?
So we didn't get much pressure data in Mukuyu 1 because of the challenges that we had with the overbalance in the main bore, where we had that. If you if you go back to some of the previous announcements with the Mukuyu-1, we had this very thick filter cake on the inside caused by the heavy mud and the barite content in particular. So when we ran the logs, we went to go and do the pressure data, and we couldn't understand why we kept getting tight tests. So we then bought ourselves some time, pulled the tool up to see if it was plugged in the probe, and then did the VSP, then cut some sidewall cores, and when the sidewall cores came back up, they had like a 7 or 8 millimeter thick filter cake on it, which was, and there's a picture of the well site geo that's actually broken a piece that looks like a rubber disc. It was solid, so there was no ways the probe was going to get through that to get pressure data. So we didn't get much pressure data. We got a few valid points, maybe where the filter cake had been kind of scraped off by the drill pipe on the way back out. But so we don't know if Mukuyu-1 and Mukuyu-2 are on the same pressure gradient, unfortunately. So that's one of the kind of huge regrets that we have from the well, is that we didn't have enough pressure data to really figure out where things were. But I think, and that question is probably more related to, is it in communication or not? I think the most likely answer is no, because of the faulting that we see in the structure. That's pretty evident on the seismic, where it's unlikely that you're going to have that continuity of that reservoir across, that's going to put it in across the fault with a bit of displacement that's going to put it in communication. But it's also probably related to column heights as well, as to where we kind of sit from a column height perspective. From all of from both Mukuyu-1 and Mukuyu-2, we're yet to encounter a water leg. So the column heights look, pretty substantial. I think what we're also seeing from a broad communication across the reservoir perspective, we're seeing the isotope data from the gas is very similar, which means it's come from similar source and is migrated and is across the reservoir, which tells you a bit about the kind of gross overall reservoir connectivity in there. So that's a good story, and we're seeing relatively decent trend in terms of vertically from in Mukuyu-1 and Mukuyu-2 between the reservoirs, and then also laterally between Mukuyu-1 and Mukuyu-2. So I think we're still getting our heads around the kind of columns and column heights and pressures and whether those reservoirs across there are in communication, and again, well testing will help that in the long run, and more pressure data from other wells again will help you. So
yeah, fair. And yeah, no, thank you. And so maybe just I think one last one here in terms of the data or data acquisition. When will we see, or when might we expect to see a 3D and seismic update?
Sure. So 3D seismic, again, something that's really going to benefit the field, because we've been doing it on 2D at the moment, and that has been good to test kind of structural locations in Mukuyu. As I said, we're chasing a big structure here. It's 200 square kilometers under closure. So to give people some kind of context, that's 4 times Sydney Harbour. For those people who live in Perth, so 4 times the area of Sydney Harbour. For anyone who's ever been to Sydney, or if you go and look on Google Map, go and look at the size of Sydney Harbour. For those people who live in Perth, where we're based, that's from Perth city centre down to Fremantle, and then back towards the hills. Huge area, and we've drilled 2 holes in it. And with 2D seismic, if you take a kind of rough grid and you say over the structure, we've got maybe 14 lines, so like 14 roads across that kind of distance, and then another kind of 3 dip lines across the structure. And you're just picking a suburb. You're picking one house on one street in one suburb to go and test, to give people an analogy they can kind of relate to. So you've only got one slice through that street, and you don't know what's in between that street and the next one. whereas 3D will be able to, have a much clearer view of what is in every single house, but what a suburb across, how the suburbs change as you move across the map. So that'll really allow us. Now we've proven the petroleum system, everything's there, and as you get to all places now, with these, you're looking at your primary risks now going into future appraisal locations are your trap integrity and your reservoir, because your sources, unless you've got some migration shadows or something, but we don't see that as an issue for us because we've got that deep kitchen in the north and we've got source rock all over the place that we've encountered in the wells. So it's really now trap integrity and reservoir. So your reservoir, you can easier map on 2D on 3D, because on 2D you're just taking a very kind of sliced view of what it looks like. So that the design work for the 3D survey has been done. We've got the preferred contractor that we're negotiating with, and we're also, again, we're very conscious of the costs. So we've been looking at how we can reduce that, and we've sharpened the costs on that really well. It's come down significantly from what we thought it was going to be, and looking at doing some of the work ourselves to help, because obviously we've got the know-how, we've got the experience in the basin, and also access to all of the kind of preparation activities that you would need. So the equipment is in our supply base down in the valley. We can start it, very quickly, and give notice to start immediately. So we're just trying to ensure, because we've got, again, going back to the funding question earlier, we've now got to essentially cut our cloth and make sure that we can fund all of these activities and not just launch into stuff and then think about the consequences later. So we've got to prioritize what we think is the best allocation of resources in terms of funding to activity. So the presumption was that we'd re-rate, we'd be able to raise everything that we needed for 3D well test and another exploration well. So now we have to make sure that we're not biting off more than we can chew from a financing perspective. So we can start the 3D anytime, and that's the cheapest activity as well that we'll be undertaking. So yeah, it's just a question of making sure that everything's lined up.
No, thank you. And we're just
and we're not robbing Peter to pay Paul from a well test funding perspective to put towards 3D, because I think everyone wants to see the well test, and we don't want to launch into a 3D and then eat up funds that are meant for a well test.
Mm-hmm. No, fair enough. Yeah, no, fair enough. And so just one more question on financials, and then we will do I think we might be done here on the 2-hour mark here, just a brief rundown of future events, 2024, 2025. But financials, just a one-off, just someone noticed that Prospectus had liabilities as of December 31st at 5.7 million, and then the half yearly had liabilities at 12.4 million at the same timetable. Can you just explain the discrepancy there? Is that, prepayment for 3D or long leads or M2 costs or Exalo to your rig? I mean, what's the discrepancy there?
Yeah. So the major part of that really is some of it is rig retention, but most of it is the rig, the future liability that we have from a rig demobilization point of view. So we've got an obligation to send it back to Tanzania, and we've had that costed up, and that's why that sits there as a major liability. So it's not something that is imminent or immediate. It's something that we believe this rig is going to be here for the long term, and ultimately it's probably not going to get demobbed, realistically speaking. But because of that's what it has in our contract with Exalo, we've got to have that there. So hence why, because the rig mob and demob is so expensive and it takes such a long time, it's far cheaper for us to keep it stacked than continually move it backwards and forwards. So I think ultimately that is going to fall away because, and that's a discussion we're currently having with Exalo because, there's not that kind of long-term pressure for them to go anywhere, or immediate term pressure for them to go anywhere. And so I think at the moment it sits on our books as a liability, but ultimately it's, that's something that's just on paper and not going to be realized.
Fair enough. And so we'll transition to the end, and people are putting in questions. I'm actually just going to copy a couple over here that I like. I'm not going to get to them, and I hope you can apologize or you'll forgive me for my apologies here. But future follow-ups, or Scott and I had actually referenced maybe doing a brief written Q&A to save him the arduous efforts that are involved with sitting down here for 2 hours. But yeah, so if you've got questions, don't get too offended if I don't get to them here. We'll try to be brief here, but send them my way, though. Please email them to me, and I can try to follow up with Scott on my own or in some sort of semi-public fashion, right? Anyway, though, just transitioning to the end here, Scott. We'll just calendar of future events. Like, I guess what's the timeline here? H1, H2, 2024, moving into 2025. So you've referenced flow tests. We can expect Q2, Q3. So run through what we can expect, I guess, in 2024 still from Invictus, if you don't mind.
Sure. So look, and we've got to approach it from a perspective of money. If money was no object, what would we be doing versus what we've got to manage? So again, I don't want to promise people something and then it doesn't materialize for whatever reason. Sometimes it's equipment availability, finance is probably the major one, because we don't want to go down this endless dilutionary cycle. So we've got to allocate our activity depending on the finance. So, and what we think will give us the best bang for our buck. So I think what we'd like to achieve this year is a flow test and the 3D seismic, because the flow test obviously I think will provide that proof that it's going to that we can produce gas, and the 3D will then allow us to use that data next year for a future appraisal drilling campaign to help us target specific areas of the field for that early monetization and early development phase, where we can focus on, because again, as I said, the field is huge. It's 200 square kilometers. So we've got to there's no point in just trying to throw darts and hit it all over the place. We've got to take some kind of methodical approach to it and build up a minimum resource base so that we can get to that early, or that we'll get beyond the early monetization stuff, but it's more building towards that first phase of full field development to get a minimum resource base that gives us access to serious debt financing. I'm not talking about the pilot phase and the early monetization stuff. I'm talking, when we're in proper full field development. So, and it's going to help us with the resource estimation as well. So it's a twofold thing: the 3D seismic, and then obviously the well test is proof that it'll flow.
Are you optimistic then?
And then
you go.
And then beyond that, tagging it onto an exploration campaign where we've got both the prospects in the east, which are shaping up very nicely, and we'll have some news on those in the coming weeks. We're just tidying up all of the interpretation at the moment, and then also the basin margin play. So that has kind of now firming up as a really nice play with, and maybe it escaped people's attention in the fluid composition results with what we've seen in the Dandy, but proof that we have got liquid hydrocarbons that have been generated. We saw some of them in the Dandy, added and had some biodegraded or biogenic gas as well mixed with it that reduced the wetness of what we saw. So the hypothesis that we've had and the geological model that we've had, where we've got richer liquids to the south of the field, of the basin, and to the south of Makuyu, And we saw that with Mukuyu-1, where we saw more fluorescence and more liquid-rich gas, so higher CGRs, than we did in Mukuyu-2, because Mukuyu-2, we've got the kitchen that's deeper to the north, and that is producing drier gas that's then mixing in with the stuff that's being generated on structure from some of the other source rock. So that has now played out from the results that we've got from that composition, and also potential for an additional source rock in the Dandy, which was what we thought was possible, but we're starting to get some information that is leading us towards that kind of conclusion. So we've got some additional work to do on that, but that basin margin play is shaping up, as we kind of hoped. So that's a good scenario. So again, we want to ensure that we can capture the value of all of that exploration portfolio that we have, because we've got a huge position there and a lot of prospects, and we've seen now, it's in our presentations how these basins unfold. From once you make one discovery, you make a lot more, because the petroleum system works its down then to an individual kind of prospect risk level, and once you get your eye in for how the basin works and how the petroleum system works, your success rates are very high. So it is something that we want to pursue, because it will add a lot of value as well. And having a diversity of plays reduces your risk as well. You've got one versus different play types. I think also in addition to the Dandy, the Pebiarcos as well is something that is now also really taking our interest, because of what we've seen so far from the results, and again, it's just getting a calibration on the play and how it works. So we've seen evidence of hydrocarbons in the Dandy. We had residual hydrocarbons. Sorry, in the Dandy, in the Pebiarcos, we had residual hydrocarbons in both of those that we identified from the logs, but from now the mud gas data and from the water sample that we got at the Pebiarcos, we've got residual hydrocarbons in that physically that we recovered. So those plays are going to work somewhere, somewhere in Mukuyu or somewhere else in the basin, because you've had charge into those, and there's reservoirs, there's seals. It's probably a trap thing for those of where they are, of where we drilled those 2 wells so far. So again, on Mukuyu, 3D will help firm up those plays if they're going to work on Mukuyu, but also it's giving us insight into the rest of the basin and where we should go and target those plays.
Yeah, so just to summarize here briefly, and you can tell me where I'm wrong, and I'm speaking very generally here, right? But if we say 6 months, and then again, this is me making up a number. Scott did not say that. I'm just saying that as a rough, somewhat arbitrary number, right? But so 6 months roughly, we could expect a flow test and 3D or something, and then. But I guess my overall point is that PPSA, flow test, and 3D can kind of get packaged into one sort of checkpoint or benchmark, and then from there that unlocks the ability for non-dilutionary funding opportunities for the company, which then from there will flow further exploration. Is that kind of a fair summary of?
Yeah, I think the non-dilutionary option isn't necessitated on a flow test or 3D, because you've got JV partners that'll farm in pre those. It just will maybe alter your terms of the deal, perhaps, but that's not out of the question. People farm in pre-drill before you made a discovery, so waiting for a flow test, it's just gonna have some kind of risk weighting on it, more so on the deal terms. But I think certainly the PPSA will be a big catalyst in that regard. I think we've had a lot of that commentary from around, not only our shareholders, institutional investors, but also some of these other parties we've been talking about as well. Because I think the reality is that from Zimbabwe's history of what happened in the previous government and a long time ago, there is that fear of resource nationalization of what happened. I think the counter argument to that is where we are today as a company and asset maturity point of view. If the government was going to start doing that, they'd go after better assets that are more mature than what we have at the moment, because there's still a lot to be done. So you've got fabulous companies that operate in Zimbabwe, like Zimplats, that are listed on the ASX. Platinum prices have been taken a battering recently, but it's an unbelievable business that prints money, is mature. They've got tens of millions of ounces of reserves of platinum. They've been paying dividends to the shareholders in Australia, and if I was in government shoes and I was hell bent on resource nationalism, those are the kind of assets that I'd be going after, not stuff that still needs some maturity and in an area that's completely foreign to government. So I think people need to put that fear aside, because it just hasn't happened. It did happen with the land reform program and farms, but it hasn't happened in the resources sector. So I think that I understand people's point of view and where that's coming from, but I think I need that little bit of context is very important.
Yeah, well, good. And I guess where there is risk, there is opportunity for those willing to assume that risk or to take that secondary step of discussion and analysis to get there. Final couple of questions here, honestly. I think, like I say, I will stress to people, if I didn't get your questions or if I shaved a couple off here in the interest of time, I mean, I have a collection of them that I'll send off to Scott for a Q&A maybe here in a few weeks' time, a written Q&A rather. And yeah, please do, send them to me as well if you have other ones. But I guess last question, Scott, maybe, and this might be it actually, is that when, in terms of pilot plant, kind of proof of concept production, realistic time frame from March 26th, 2024 to then, what is that time frame?
Look, I don't want to preempt anything, but I think it'll happen quicker than people think. There's been a lot of, I think the fact that we finished drilling a well and we haven't had a huge amount of news flow. People think there's nothing going on in the background, but that's far from the case. There's a lot of things in motion, and it'll kind of coincide with I think an overall strategy picture that we'll put out for the company. Like we passed that discovery phase and articulating how and laying out to our shareholders and investors how we're going to take the company and the asset forward. So I think there'll be some concrete developments on that front very soon.
Well, there you go. I'm excited now. So good. No, final thoughts to you, Scott, before I say goodbye and say thanks.
Yeah, Matt, thanks again for hosting me and providing this platform, for me and for our shareholders and people interested in the story. I know, it's been a tough few months, and I didn't think that we'd be in this position where I feel like we're back in the trenches again, where we should have been, as I said, taking an Everest analogy at kind of base camp and looking up towards the summit now. So it's been very disappointing from that perspective, but I don't think it should detract from what we've achieved. And sometimes I've got to separate, the capital market stuff from the project stuff, as hard as it is, because they do go hand in glove, and the market is the weighing machine at the moment. But keeping score and the perception. But I think all companies that are going through these growing pains, and I mentioned, a few before, where sometimes it takes a little spark and all of a sudden the picture changes overnight from where it was, and it just takes interest from someone else to articulate that value of where the company is. So it's we are hard at work. I think just because there hasn't been a lot of news flow, there is a lot going on in the background, and there's a lot to come. But we are, we've got a very devoted team who believe in the company, believe in the project, and the direction that we're heading. And, like to thank all of our shareholders because, again, we had to provide opportunities for people to invest. I think the fact that will do a lot of good and change an energy dynamic in a country and in the region. That's fabulous. But again, we recognize at the end of the day, everyone is here to invest and make returns. So we will do our utmost to ensure that we give ourselves the best opportunity of people realizing that. And so every decision that we make, every direction that we take is with that in mind, because, as I said, our board and are all invested. We're all shareholders, and we're doing what we believe is going to realize in the ultimate, kind of destination of the company. Yes, there's going to be some short-term challenges, but we've navigated them before, and we've come out the other side, and I believe we'll do the same. So,
no, excellent and well said. And I think I speak for everybody here. I mean, I know personally speaking, I've spoken to dozens, if not hundreds, of managing directors and CEOs at this point, and I can tell you a precious few would be willing to. These sort of live conversations with the 200 people now down to 140 it can be potentially dangerous situation, and for a managing director, for a leader, right? And so I think that everybody here appreciates your openness and your ongoing kind of good faith approach to this, and your desire and willingness to engage with us, right? People just want to be told and want to know and to understand, right? So yeah, the kind of a sincere thanks from me and from everyone here as well. And there's lots of kind of positive words flowing in there in the group chat I see. And otherwise, though, yeah, Scott, thanks for your time. And like I say, I'm sure we'll be doing this again sometime soon, and hopefully, knock on wood, right, with we'll have some positive news flow we can crow about, right? So
great, Matt. Thanks for having me again, and thanks to everyone for listening, and appreciate your time, and take care.